where it will go post-COVID to be seen. However, the stock of central bank cash in circulation has not declined. In fact, it's actually continued slightly to increase, actually. You might call that the paradox. Lord King's nodding because we've had this conversation in the past. I mean, there are other reasons why I think that is, taking place. So I describe it as a paradox. It's a paradox that, that can, I think, explanations can be offered for why it is the case. But I just want to emphasise that it's not our intention to remove that access or that point of access and use from the consumer. Not least because all our evidence that we gather said there is a section of the population that does continue to rely on cash and wants to continue to rely on cash. And I would say that some of that section of the community is the more vulnerable part of the community, and I think it's important that we continue to provide that, to meet that need.
Do you see any danger in the? I mean, at the moment, if I pay for something by cash, no one except the receiver of the cash or myself knows about it. I mean, once you get once most transactions become digital, then they will be known by someone else other than the parties making it, and that can be used. Do you see any real danger in the scope for increased surveillance, which results from a diminished use of cash?
Well, I'm sure John will want to come in. Let me say, I think one of the hardest decisions, should the decision be taken to go ahead with central bank digital currency, one of the hardest decisions will be where to draw the line between privacy and the need for, obviously, transaction monitoring and tracking for financial crime reasons. Now, of course, that is not different, I should say, to many private sector, commercial money systems today. It's not different at all, actually. In many ways, it's cash, of course, that has the different characteristic as you described it. But we will recognise, and I should also say we recognise, which is why the Treasury are leading on this work in a cross-government way, that, of course, that's not a decision that the central bank should certainly not take on its own, nor is it something that we would consider ourselves to have the sort of comparative advantage of knowledge in.
Just before, I know that we want to come on to the privacy in rather more detail.
Sorry, I should have waited.
So can we stick on your main point now, and we'll come on to privacy later. I know that.
Yes, I mean, I still am not sure why a new central bank digital currency will improve the service for the customer. I now pay by credit card when I pay, my taxi. Now, I use the cards for all kinds of purposes. Why would this currency really improve what I can already do?
So maybe I can say to you, this question of the use case from the user's point of view is one of the key issues that the task force is looking at, and also the engagement group with the private sector. I'd make a number of points there in response. One is just the basic point that if a central bank digital currency would play an important role in anchoring confidence, interchangeability, substitutability of money, that is a benefit for the consumer. The consumer doesn't realise what would happen if monies weren't substitutable and you didn't have confidence in it. But there's a basic point there about the user's trust and ability to use different forms of money without ever thinking about, am I using this bank or that bank or cash. As to Patrick's point, and I read his evidence, I'm not sure, to be honest. I agree for two reasons. One, the very important thing is there are consumers, there are also merchants. And it's the merchants who see the cost of you're using a credit card. If you're a large company, then the cost is probably around 30 to 40 basis points. If you're a small business, the cost can be 200 and more. And there's a whole range of fees there. So when we think about the user, we should think about the merchants and convenience. And at the moment, merchants have the ability to say, well, I won't take digital. It's becoming more difficult for them to refuse digital. I'll take cash instead. But actually, as that becomes more difficult and fewer people want to use cash, the question is, should they have an alternative that anchors the cost floor? And the second point I'd make, it's this forward-looking point. So if I can give a slightly odd example, when the iPhone was introduced, I don't think anybody had any idea of the range of uses that it will be put. I certainly didn't. I resisted one for a large number of years. If you look at the experience we've just been through over the last year with the vaccination QR code, living without a smartphone is now quite a difficult thing to do. It's quite difficult to predict how innovators will take money and actually use money going forward, but we're starting to see programmable money being used, certainly in the crypto world. And I would expect that we will see a similar revolution in the functionality of money, driven by technology and the private sector going forward. There are examples of that already. The question, though, is if that happens, it's not really comparing CBDC against the current world of banks and credit cards. It's comparing CBDC against new forms of money issued potentially by different players, although the banks would issue, I think, in their own right. And given the time that public policy takes, I think if we want to be in a position to say, in that world, we want to provide a public digital asset that the private sector can use to innovate, rather than, if you like, leave it to the private sector, because, as you know, there are network externalities to money, and there are strong possibilities of closed systems. So providing something that private sector can use to innovate and provide new functionality, that's part of the answer to Patrick's question. I think if you look at the status quo, you say, well, okay, I can do everything now. If you're a merchant, you might not be so happy, but consumer doesn't see the cost. But if you look to the future, I think in the same way that you couldn't really anticipate how you would use a smartphone, I think it's quite difficult to anticipate the changes we might see in the way money is used.
Thank you.
Lord Bridges, you wanted to come
Just to quickly come in and pick up Sir John on his comments that the Chair referred to in the Telegraph. I'm sure read the speech that Governor Waller gave about CBDCs, a solution in search of a problem. And also the speech that Fabio Panetta gave in Madrid earlier this month, in which he said, I'm just going to quickly quote it, with digitalisation at full speed, central banks must prepare for a digital future in which demand for cash as a medium for exchange may weaken, requiring the convertibility of private money into cash to be complemented by convertibility into central bank digital money. This is the primary reason why the ECB would issue a digital euro. Is that the primary reason why the bank, therefore, would issue a digital euro? Is that just to pinpoint the actual primary core reason?
So I think there are a number of public policy reasons why one might. It's important to emphasise that we haven't taken a decision, and this will all come out. And the reason for going ahead or not going ahead will be subject to public consultation, with a paper coming out next year. But from a central bank perspective, if you ask me what's the driving reason, it's the point that Andrew made, is that cash does play a role in tying the system together. The fact that you can move commercial bank money into cash on demand means not only it's substitutable, but it also means that it's interoperable and all the standards work together. If the question, and that's what Fabio Panetta was saying, is if that disappears in a world where money is changing very quickly, can we ensure that the public has confidence and money that it can use regardless of whether it's public or private? It's that anchoring role, I think, that is hugely important.
That's extremely helpful. So, because we have been told various benefits that may arise from the CBDC, for example, financial inclusion, cross-border transactions, and of course competition in payments. But you're saying that that is, just for the absolute sake of doubt, the primary motive is what?
So I'm saying from a central bank perspective, that is the primary reason. If I was sitting in a competition authority, I would worry an enormous amount about a big tech social platform issuing its money and locking people in. If I were worried about digital exclusion, I might worry about some of the forms of money that might be adopted, and ditto innovation. But you asked me as a central banker, what's my primary concern? It's about the confidence and the interoperability, the unity of money in the UK.
That's great.
And I should say, this is not the only way of doing it. One could do it through regulation. One could regulate. I mean, one could regulate all these things. It's not saying this is the only way, but actually the history of trying to regulate firms with businesses with network externalities in fast-changing technological environments is not unmixed. And the question is, does a public sector option and convertibility into that public sector option play a supporting role in addition to regulation? Otherwise, as Andrew says, we're faced with regulating big techs potentially, or new players that are not banks. It's rather different world.
Lord Monks.
Thank you, Chairman. This is a question about commercial bank disintermediation and about how far you've got up to date in in deciding what level of disintermediation the bank would be prepared to accept if you decide to go ahead. We've heard that if the scale is large, there will be implications for the availability of credit, also for the stability of the banking system and perhaps also for monetary policy. Too little intermediation and the whole thing's a bit of a damp squib and nothing really happens. So how attractive should a CBDC be to hold and to use? Where's the lines to be drawn?
Could I start on that? I'm sure John will want to come in, but I just want to follow on from what John was just saying, because it's a very important question. When I approach it, I don't see it as a sort of binary, if you like, sort of decision between central bank digital money and commercial bank deposits. I think John was giving the example of the way innovation is going and the fact that we could easily end up, and let's face it, there's a proposal been around for several years from Facebook to have essentially their own money. Comes back to the stablecoin point I was making. So I would really see in that way as saying, what are we going to see in terms of, if you like, sort of disintermediation of the money system out of the banking system into things like a sort of a private money within, let's say, the Facebook system. Let's use that as a very good example. And where does central bank digital currency fit into that? And I think, as John was saying, the question we then face, and I think I said it earlier, is, would we try to regulate that, or actually is the answer really, if that's what you want in terms of access to digital currency and digital payment mechanisms, then it would be more straightforward to have central bank money fulfilling that function than to have essentially new developments of private money. So I don't see it in terms of a sort of, if you like, a sort of a binary sort of, how much off the banking system, how much on the central bank, as opposed to there is a lot of innovation going on in the world at the moment, which may start to, frankly, break up some elements of the banking system if it really gets hold. And what do we think of the stability of that, and what should be the response? So that's the framework in which I see the answer to that question. And we want to.
I'd say I distinguish between steady state and transition, because I think that's very important. So were we to introduce a central bank digital currency, given that we can't know, and you're entirely right, Lord Monks, I mean, on the one hand, people tell us this will disintermediate the banking system because the use will be enormous. On the other hand, they say, well, consumers have no need for it, so no one will use it. But the honest answer is we can't know the behavioural response to a central bank digital currency until it happens, any more than you can ask consumers, but if you ask them whether they need something that they don't have and doesn't exist at the moment, it's unlikely to be a hugely reliable answer. So some of this will come down to the design. And this, the concept we're exploring is a retail payment use for this money. So some of how much is used depends on where we put the boundary between retail and wholesale, and how much we allow this to be used in wholesale transactions, and how much it is restricted. Things like, should this be usable for payroll? Should it be usable for pensions? Or is it just usable for internet transactions and the like? So some of those decisions about where the best use case might be will determine take-up. There are other issues about which the task force will look at, which is, should it be remunerated or not remunerated? You referenced Fabio Panetta's speeches and earlier work by Panetta and Binsell that suggests different remuneration levels. Or should this be like cash, actual cash, and carry no remuneration at all? All those things will affect take-up, and I think we will need to test the kind of modelling I gave you earlier against actually a design which will give us some idea of how attractive it will be, how much it will be used. The transition point, though, is really important, that given that we don't know demand, we don't know how consumers will react, one would want to introduce anything like this quite carefully, in my view, so that as you discovered what the response was, you would be able to kind of change the features if you needed to, but also to give the banking system time to adjust to what it meant for them in outflow. But as Andrew says, if we don't, the banking system is going to have that challenge anyway, I suspect, unless we ban, as China has done, some of the new technologies and new players in the system. And I just don't think that's very practical.
I can accept that you don't want it to define these choices necessarily as binary, but that you can see from what's just been said, I mean, there's a whole range of choices that would have to be made, and they'd have to be made with digital technology around at great speed. So, for example, if there's an economic downturn and some of the banks are a bit in a bit of trouble, like the energy companies at the moment, there'd be a great attraction to get into the central bank digital currency. You could suddenly find a run on the currency, or on the banks rather, and it would be very fast, faster than we've ever been used to.
That's a very important point, because in essence what lies under that point is that we would be making the public's access to central bank money much easier than it is today. Because the only way that the public can access there's two forms of central bank money at the moment. There's currency and there's reserve accounts at the Bank of England, but the public can't have accounts at the Bank of England. So the only form of access that the public has to central bank money is banknotes. And that obviously has a limiting effect on the public's access, and it does in a run. I mean, again, one of the ironies, I'll tell you, of the Northern Rock run was that the public actually didn't run into central bank money. They queued up to get checks, which of course is just transferring one form of commercial bank money into another one with a 3-day clearing delay. I mean, it's always one of the slight ironies of that situation. This would of course change that fundamentally. Now, I must say my own view on that is that I think, and this is what we've been doing, of course, since the financial crisis, is that in a way the big answer to that question is not digital currency. It's actually to have, appropriate regulation and even more so appropriate resolution of banks, so that you can deal with those problems promptly rather than have them take hold. But it's an important point. So, I mean, I don't, when saying that, I don't want to in any sense diminish the importance of the point you make.
If I can add to that, so we have the problem at the moment. We had a recent experience of a bank which was rumoured to be in trouble, and it took on Twitter, and it took less than 20 minutes for an internet run of uninsured deposits, wholesale deposits, to start. So to some extent we're talking about how much more powerful the dynamics become, not whether the dynamics are new. So and Friday night is no longer a safe resolution weekend, because actually, and we saw this in Northern Rock, people have access to their bank accounts over the internet. So we're dealing already with a system in which money can move out of one bank to another bank quite quickly. I think if we were dealing with an individual bank, it's not clear to me that people would necessarily run from an individual bank to central bank money and stay there rather than run to another bank. If we're dealing with the banking system as a whole, and my recollection is 2009 felt more dealing with the banking system as a whole than dealing with an individual bank, I think you either lock the money in the banking system through resolution, which we can now do. You shut the bank down and you freeze it, and then on the Monday morning you hope you reopen it, having bailed in, using the resolution tools to bail in the bondholders, or you have to publicly support the bank. And I guess a CBDC may change the dynamics of that, but it doesn't change the underlying issue that if you really have a problem of confidence in the banking system as a whole, somebody will have to pay to repair the banks, and the public authorities need to move in quite quickly. But where I think the decisions will be faster, potentially, if people could move into to CBDC, but they're not, if you like, they're not different decisions. And the last point I make about cash, and I say this as somebody who walked past the Golders Green branch of Northern Rock at the time, the pictures on the television of people queuing at ATMs and they were certainly queuing outside the Golders Green one, I think, accelerates a bank run, I think, as much as a run into CBDC. So it's, to my mind, these are problems that we have to deal with at the moment. They may come at us more quickly, and they may come at us with a bit more force, but it's not a novel issue.
Okay, Lord Fox.
So coming back to the disintermediation issue as raised by Lord Monks, at the beginning you explained a scenario of assumptions that you were modelling around. What was the assumption in terms of the customer relationship? So, for example, are the customers previously of the commercial banks, are you modelling that the Bank of England will have a direct relationship with those customers, or will it assume the relationship through the commercial banks? And things like know your customer, will it be the Bank of England who will be managing that process? And how does this changing role of the commercial banks fit into that?
The modelling was just, let's take an assumption that 20% of transactional accounts move, basically all uninsured deposits move, and illustrate what the impact will be on credit availability and on the banking system. It didn't go to the model itself. I think the central assumption we're working with is a so-called platform model, which will be a partnership between the Bank of England and the private sector. So in the same way that we don't issue cash directly to the public, we issue it to the banks, we then issue it to the public. The interface with the customer would be private sector. Might be a bank, might be a wallet that's not a bank, but we would not give customers direct accounts at the Bank of England.
That's very important.
It's really important. There are some proposals in other jurisdictions to give customers direct account, and I think it comes back to what Andrew was saying, is the intention here is not to disintermediate the banking system by putting the Bank of England where the banking system is at the moment. The aim would be, if you like, for us to provide the settlement asset, but for the private sector to deal with the distribution, the storage of the settlement asset, and the technological innovation around the settlement asset. And actually some of the players here say we wouldn't introduce a stable coin if we could use a Bank of England digital currency instead. Our interest is not in the coin, our interest is in integrating a digital settlement asset into our social platform and the like. But we don't envisage, as I say, I don't know I can't say where this will come out, but I think in everything we've said publicly in the discussion papers, we've envisaged this public-private partnership without the Bank of England giving accounts to people.
Okay, Lord Livingston.
Thank you. When you were here talking about QE, we talked quite a bit about the extension of the Bank of England's responsibilities and powers as a result of QE. Taking that now onto a CBDC, what do you envisage in terms of, do you think that there are more, it will give the bank more powers and indeed more responsibility, and how's the bank thinking of that?
Well, I think John has framed the answer by what he just said. We do not see this as the Bank of England moving into sort of retail bank account business through central bank digital currency. It would be providing, if you like, the sort of the means of settlement, and therefore the central bank money to a platform in which I would imagine banks, as John was saying, maybe wallet holders, although I think they would have to be regulated. That's essential. So whether they would be banks or not to be decided, would be the participants. Now, in terms of if you put that into powers, I think the bank would have to have, if you like, regulatory powers over the firms that were on the platform, as it were, because that's the direct interface. It wouldn't, if you convert that into sort of legislative powers, I don't think it would actually involve changing the legislation around banknotes, because these are not banknotes. So it's far more in the sort of the reserve account arena, which we have today. But I think there would be issues for the whole system, and I think that would be to do with the legal framework of payments, which I mean end to end. And as we were touching on earlier, come back to, I think the chair said, issues around privacy and personal data, where the question would be, does the current legislative framework actually do it once we understand the design? But I think all of those things are not powers to the Bank of England. Those would be powers to enable this thing to work.
just taking that on, I was thinking a particular area of what used to be called unconventional monetary policy, which is conventional now. That does.
I wouldn't go there.
We're coming there.
Later. Does a CBDC give the bank significantly more opportunities to transmit unconventional monetary policy? I'm thinking in areas such as potentially helicopter money, or even the Bank of International Settlement. I think talked about time-limited money, to forcing it to spend it on certain things, and indeed, although I think you may, changing the interest rates on if the CBDC was remunerated or wasn't, and then changing. So, I mean, it just seems to give substantially more opportunities to intervene, and therefore with all responsibility, with all power comes responsibility.
Yeah. So I mean, let me give my own view on this, and it's helpful to come back to the title of Christopher Waller's speech, as I think as all Bridget said. What problem are we trying to solve here? I don't include in the set of what problem are we trying to solve here monetary policy. So I do not see this as a means to, for instance, implement negative interest rates. It's currency. It's not for me in that sphere, and I think it confuses and complicates matters if we take it off down that road. So negative interest rates, helicopter money, no, that's not the reason for me that lies behind any of this, frankly.
And do you think the bank should set out, I mean, that's a very clear answer in setting that out, because I think it could give the capability, and setting that out and saying that's not what we're going to do. And if we did, that would be a Treasury decision, because obviously it has a whole fiscal element to it as well, for helicopter money.
Well, I mean, we're doing, obviously, as John described earlier, a large amount of work on this with the Treasury in the task force, which John's heavily involved in. And obviously, there's going to be a consultation next year. All of these things ought to be, will be, I'm sure, laid out very clearly at the end of that. I think it's appropriate to have the consultation, by the way, and not assume the answer. I'm giving you my own view. And I would, I'm going to take a lot of persuading to come off that view, frankly. But you never know. But that's very clearly my view. I think we will reach the answers to those questions. And if you don't mind me saying something, people sometimes say, well, why are you taking so long to do this? I think as this discussion, these are pretty profound issues, frankly, and they need to be they need to be sorted out properly. But that's where I start from. This is not about monetary policy.
Okay, thank you.
But it could be.
Yeah. Well, people, I mean, look, going back to the Christopher Waller question, there are people who use that as a sort of a framework to bring it in. That's not my view of the world.
Governor, I'm sure you'll be there for a long time, but governors come and go, and different governors...
I'm very much hoping they do.
But
he's looking so well, so I'm hoping for the best for the future.
But the question is whether or not it could be used for this purpose. You're saying it wouldn't be your intention to do so, but others might.
That's in fact, John's comment earlier about the iPhone. Nobody thought it would be used as a QR code for it doesn't create the framework that allows future usage, and therefore should it be...
In principle, yes, it does, because of course once you put it onto a computer system as opposed to bits of paper, you can do things that you can't do on bits of paper. Yeah.
So just if say that I think my guess is when we come out with the concept, the problem we're trying to solve is the problem of retail payments and the public's use and confidence in money. And my consultation will be around that. I'm pretty sure that we will get people on both sides arguing, because I've had representations that this is a huge possibility for monetary policy, and etc. Why don't we do that? I don't think, though, those questions won't go away if we don't do a central bank digital currency, if I can put it that way. The question of negative interest rates is kind of out there. The questions around monetary policy are out there. And people will innovate in certain policy situations, as central banks have done a lot since the financial crisis. But it's not solving one problem because you might be creating a technology that might at some future point be used for a purpose you didn't, I think, would be a strange way to approach the costs and benefits of this. And clearly if society said no, we didn't want that to happen, they could legislate to make sure it didn't happen. But of course even Parliament can change its mind
I mean, you are very, thank you, you've been very clear on what it is and what it isn't. It's quite interesting. It is a number of witnesses, particularly looking at other countries, have come to quite different conclusions about about what they would use a CBDC for, and actually, some people have said actually it is a wholesale mechanism, and don't, frankly, the consumer element of it is can be handled. But
well, I'll just...
We'll go into that later.
On that, well, maybe if you want, that's happy, I'll save it. I mean, we don't need CBDC for wholesale because we've got real-time gross settlement in central bank money.
Indeed, which is a restricted rejoinder.
I think this is a point that Baroness Kramer wanted to present.
Right.
Well, yes, I mean, walk straight into my question.
Right.
Which, obviously, the whole discussion so far has been focused on the bank's plans to look at a retail CBDC, but we've had quite a few witnesses who have talked about the potential benefits of wholesale. And I'd like to hear from you why your thoughts are that you're not looking at wholesale, and why you don't see potential efficiencies that can be introduced, for example, in the settlement process through wholesale CBDC, rather than just improving or innovating around existing systems.
Well, I'll start off. There are two forms of central bank money, as I said earlier. One is banknotes, the other is reserve accounts at the Bank of England. And the reserve accounts, of course, are held in electronic form. For 25 years now, we've had real-time gross settlement for wholesale payments in this country, and that real-time gross settlement occurs in the Bank of England between reserve accounts, between commercial banks' reserve accounts at the bank. So that is real-time settlement in central bank money. Now, we are in the process of renewing that system, actually, because it is 25 years old. It's very vulnerable, but it's come to the end of its life, and it needs to be done for two reasons. One is it is 25 years old. The other is it needs to be done so that it can be more open to some of the innovations that are going on. But what that does, and will do even more so in the future, is enables real-time settlement in central bank money for wholesale transactions. So I don't think we need anything more than that, frankly, or at least I need to be persuaded that we need anything more than that.
So I'd maybe add two things to that. One, if we used, so we haven't decided to introduce a retail, but we also have not decided what technology to use. So everybody assumes we'd use distributed ledger, but actually that would follow on from a decision to go ahead. We shouldn't let the decision be driven by technology. We should let the decision be driven by if there is a problem and what the solution is. But for retail, it would be a new thing because the public does not have access to central bank digital money at the moment. For wholesale, it's more the situation you describe. It's can we improve upon what we're doing at the moment with electronic technology by using some new forms, which might include distributed ledger technology? Would that be more efficient? That doesn't raise the same public policy questions that retail does. But it's not quite right to say we're not looking at that. So the bank published a paper on omnibus accounts, which would give the banks that currently have access to central bank digital wholesale, which would enable them to use a digital coin between themselves, and then the omnibus account would settle with the Bank of England. So that would be a way of introducing this technology to that set of players with whom we deal at the moment, who currently have access to central bank digital money. And there are a number of proposals. I'm not going to name check different banks, but there are a number of proposals around to do precisely that, which will be a way of introducing the technology on the wholesale side, and we're working with them. So it's not retail or wholesale. Retail gets more attention because the public policy issues are bigger. Wholesale is more about can we use this technology to be more efficient. And the RTGS renewal that's being planned will have the ability to dock into a distributed ledger technology. I mean, it's being designed so that it won't be distributed ledger itself, but it's been designed so that it could interface with DLT systems if that became necessary. So when people say to me, why aren't you doing wholesale? The answer is we have wholesale. There may be technological changes that are needed, the private sector is working on, and we're working with them. But it doesn't need the same sort of attention, I think, as the questions that we've been asked. here today.
Well, I mean, I suppose I asked the question for two reasons. I mean, one is we have Standard Charter as an example of a bank that seems fairly convinced that it's wholesale digital, that's fiat currency, that offers opportunities for greater efficiency, and is quite open that, you know, this is an unsentimental industry. That's give them an efficient, cheaper settlement mechanism, and they'll move basically their operations to that location. So it creates issues, particularly, doesn't it, around the City of London and its future. That operates surely on two bases. One is the actuality, and the other is the perception. I remember conversations, for example, that we had once on the issuing of green gilts that's in London. That's, well, we don't have to do that. We can use the existing system to invest money into green items. We don't need a green gilt. That's, now we have a green gilt because the perception of engagement, leading edge, sort of cutting innovation and leadership around those issues actually has a fundamental impact.
I mean, can I just distinguish on the standard? I'm not quite sure what lies behind the Standard Charter point, but I think it's important to distinguish here between wholesale settlement within a single currency, sterling, and cross-currency. John is leading the international work on cross-currency. That's a second issue. Yeah. You may want to say something on that.
Well, could I just ask a question? That can you do engagement in the international arena unless you have a wholesale digital currency?
Oh, yes.
Yeah.
Okay. Yes. So
be separated off.
Oh yes. Well, it's not a question of separated off. So at the moment cross-border, at the moment cross-border payments are slow, unreliable, and expensive.
Yes.
Okay, so they're stuck in somewhere between the 1960s and the 1950s. I'm not sure exactly where. There are different parts to that. So one is the correspondent banking system, which is the oldest part, which is doing a lot of the wholesale. And I think this is where Standard Charter are thinking, which we can improve a lot without a sort of central bank digital currency, but a central bank digital currency used between participants might well improve that. And some of the proposals that we're working with and the idea of omnibus accounts would actually allow that to happen. But of course, a number of jurisdictions would have to agree. Some of that is actually, we have faster payment services now, faster payment systems in a number of jurisdictions. And I think Lord Skidelsky was alluding to that when he talked about using the credit card and the like. And there are a number of proposals to link those up, which would improve the transmission of retail payments, particularly using existing technology, because even if CBDCs are introduced, they're not going to come in worldwide for quite a few years. And the third, which we're exploring internationally as well, is the extent to which CBDC and stablecoin, which would use completely different payment rails, could be used to improve retail. And the international work is kind of working on all of them. And I think my guess is the answer is going to be a mix of upgrading some of the existing technologies, using some of the opportunities of the newer ones that are just coming into place, and actually developing some of the ones that are on the horizon, which is CBDC. But there's a lot we can do in international payments without CBDC.
But could I just ask you, Governor, on the position of the City of London issue and global leadership? To what extent that is potentially weaker, that's without a wholesale.
But I'm not quite clear what wholesale system we're talking about. We've got a wholesale sterling system.
You basically say we have a wholesale CBDC just by another name.
It's called real-time gross settlement in central bank money. Now, over quite a long time, there has been a way of linking up the different real-time gross settlement wholesale systems across the major currencies. It's called continuous linked settlement, or CLS. The question is how to move on from there, really. And this is what John is leading this work internationally. So I can assure you, we're not we're not behind the game here, I think. Going back to the Christopher Waller point, I mean, if you have to list the sort of what problems are we trying to solve here, actually, as John said, cross-border payments is an obvious one, but it's a very, in a way, it's a quite unique one because it's a cross-currency issue. It's not a single currency issue.
Do some more of that in a minute. John, I'm sorry, Lord King. Sorry, I'm just sorry, I was distracted because there's about to be a vote in the chambers, so just might.
If bells go off,
Yeah.
we'll take a break.
Okay.
Thank you, Chairman. Mr. Governor, it's very nice to see you in person after this.
Good to be here in person.
So I wanted to ask some questions about this link between central bank digital currencies on the one hand and the existing payments on the other. You've been very clear, it's been very helpful for you to say to us that at the wholesale level, you have this entire network of payment systems which the bank has been improving year by year for a very long time. Carry on.
Yep.
So a central bank digital currency is not necessary in that area. It is, in other words, we already have the equivalent of that in the current system. So you talked a lot about the retail dimension, and that is something which I think is a bit different from many of the witnesses so far. So I think first it's helpful to clarify that CBDC is not a currency. Sterling is the currency.
Yeah. So it's
CBDP, Central Bank Digital Payment System, is really what we're talking about here. So my question is this, that you said that obviously you don't want to have responsibility for managing 50 million individual accounts.
No.
So this will be done with the commercial banks in some sort of partnership. What's the real difference between that and the Bank of England, in essence, standing behind deposit accounts at present?
Well, that's an interesting question, isn't it? I mean, in a sense, put it into sort of classical sort of monetary terms, it's the difference between inside and outside money. I guess the question is, are we now blurring the distinction between inside and outside money to the point where it, partly given the regulations and the extension of deposit insurance that's gone on.
And the expectation that
real
real prices,
yeah.
no one's going to let the banking system go under.
Yes, but of course with that goes the whole sort of panoply of regulation and resolution that we've done, so that it's not costless. I mean, otherwise, as you've spoken on many times, the whole discipline goes out of it and the moral hazard problem sets in. So I think so central bank money is different there, I think, because clearly it's risk-free, it's a risk-free asset.
But how would the system work? If I'm an individual, do I have separate bank accounts with my commercial bank? One which is my digital account backed by the Bank of England, and the other is just an ordinary central commercial bank account? Or is it up to a certain limit? How would that work?
So first of all, I agree with you entirely on currency, but in a way the term is out there now and difficult to change it. I'd probably refer to it as central bank digital money. Money as a means of payment rather than central bank digital currency, but the horse has kind of bolted, I think, and once an acronym becomes established, it's really difficult to change it. On the what the difference would be, I think I'd make 2 points. The first is I said we could achieve perhaps the same effect around unity, confidence, interoperability through regulation. So what makes commercial bank money interoperable, safe or whatever, is we regulate the banks, we have a resolution regime, we have deposit insurance, the banks settle across the Bank of England's books, and of course we have lender of last resort if that is necessary, and we have cash, which you can go from one form of money to another. So the argument I made for cash playing an important role, which I think it does actually, I think it plays an important psychological role in anchoring money. You could say, well, we can do all that. The Bank of England can stand behind, can regulate, can give lender of last resort, and then people can use commercial bank money with absolute confidence. And we could do the same for stablecoins. But then, of course, we get into some of the more difficult regulatory challenges that Andrew was talking about, with new forms of money and new players. And actually, that underlying requirement to develop to produce cash on demand anchors an awful lot of our regulation, as you know, around liquidity. So the difference, I think, is a difference that the public holds a central bank asset. They hold, if you like, the safest form of money. Cash holdings have gone up as Andrew said, in the pandemic, even though cash transactions have gone down, because people felt they wanted to go to some form of safety. So that's the kind of, if I could put it, the psychological role, the public having access.
That's true of cash, but if you had this retail CBDC,
how it might,
if it's done in partnership with a commercial bank,
Yeah.
I, as the holder, don't have a claim. I don't own an asset issued by the central bank. I own an account with a commercial bank.
that's not.
Oh, well,
So if I might, that's not necessarily how it's determined. So you might have a form of money which is a claim on a commercial bank, and a form of money which is a custody account, a custodian account with a commercial bank or with a wallet. So the wallets that exist in this world, and they exist already, are not banks. It's not a claim on a bank. It's actually a custody relationship, as if you had put your banknotes into custody, into a safety deposit box, and you take them out. And those custody arrangements for store of value, if I can put it, are growing in the economy anyway, which is why I think we need to regulate wallets. So it's quite possible that you would have a bank account, you might have your savings as a claim on the bank, they might be remunerated, and you might transfer some of that into CBDC, which would be like taking cash out of an ATM, but it would be held in a digital wallet, possibly operated by a tech platform, possibly operated by your bank, and that would be under a custody arrangement, a custodian arrangement, rather than a claim on the banking system.
We'll just suspend the sitting until the noise stops. Yeah, sure.
Look, could I just finish the last bit?
No,
we have some of that already with e-money.
You just hang on a second. We've suspended the sitting. So
Sorry. Yeah.
another one.
Another.
Like we have a rogue bell.
Hang on one second. I'm just going to start the session again. Okay. So, Sir John, you were answering Lord King before we were interrupted by the division bell.
Thank you, Chairman, and apologies for jumping the bell. But we have something analogous to that already with e-money. So if you use an e-money provider on the internet, you don't have a claim on the bank. You've left a balance with a provider that it's more like a custodian relationship than a bank claim under the e-money regulations. So it's not something that doesn't exist at the moment. I think that form of store of value, if I can put it that way, will grow.
Sort of digital wallet that you described, both of you, looks awfully like a sterling stablecoin. And since in your own speeches you recommended regulation of such stablecoins, you would have to regulate digital wallets in very much the same way as you would a bank offering a bank account. So I go back to my question. Let's suppose hypothetically that you imposed a system of regulation not dissimilar to where we are, which is where banks had to pre-position enough collateral to back their current account deposits that could be used for payments. All bank accounts would then be backed by the central bank. I don't really see the economic difference between that, which is very much the system we've got now, and having a central bank digital wallet.
Well, you could imagine a stable coin that is 100% reserve backed, 100% backed by a reserve account at the Bank of England.
Yep.
And you can well say, well, what's the difference between that and a central bank digital currency? And of course, again, sort of slightly ironically, we have something in this country that's not a million miles away from that in the paper world, which is Scottish and Northern Ireland banknotes.
Indeed.
Which are, fully backed. They weren't, of course, until your time as governor, the system was changed, but they are now.
Yep.
And I think it's an interesting question, and one that we are, very aware of. Now, I think there's an interesting question, of course, as to whether, as a commercial proposition, a stable coin that is 100% reserve backed is a sort of commercial proposition, frankly.
Indeed.
And the flip side of that is, would we be content with anything less than that, which I have to say would take a lot of persuading, frankly.
Indeed.
And by the way, there are some stable coins around today, not in this country, which claim to be stable coins, which are anything but in that sense, in terms of the makeup of their assets.
Indeed. So there doesn't seem to be a really big difference between the CBDC and managed things.
There is. Let me say. Because the CBDC would have an underlying claim on the Bank of England. The stable coin would have a claim on a set of assets. It would have to be, as again we confronted with Scotland and Northern Ireland, it would have to be bankruptcy remote from the rest of the entity. And that, by the way, I referred to Facebook earlier on. That would be one of the big issues about, say, a Facebook stablecoin.
So I think I'd say if, and the IMF sort of set this out in a report, if we, what regulation to apply to stablecoin is something we're wrestling with at the moment. And the discussion paper from March put out 4 different backing models, one of which was central bank reserves. But if we back stablecoin with central bank reserves, then effectively we would have introduced a synthetic CBDC, if I can put it that way. So I talked about a public-private partnership in which we issue the settlement asset and the private sector deals with the interface with the public. We would have moved the private sector higher up the chain, if you like, and we would issue reserves and the private sector would issue the coin. But effectively we'd be doing the same thing. So that's one of the things we'll look at in the task force. But the question would be, if we are going to fully back the coin with central bank reserves, would it make more sense for us to do the issuing, to run the central infrastructure, rather than for every, if you like, stable coin to take the backing and run their own system? And can we enforce interoperability better if we're at the centre of the system and enforce the standards?
So my question is,
it will be the same thing.
That if you run the system as you do now, then actually bank accounts are very close to central bank digital currencies. They're backed by the central bank. You could ensure that the regulation makes sure that is the case. So it really is a question of looking at, you'll have to have regulation on digital wallets, stable coins, whatever the vehicle which partners would issue. Sounds to me very similar to the regulation we have at present for banks.
we might not. So there are questions, and the FPC a couple of years ago, Financial Policy Committee, put out an expectation for stablecoin was that users should have the same level of confidence that they have with existing commercial bank money and the like. Whether the regulation would be exactly the same is unclear, because of course for banks we're also regulating for maturity transformation in a way that, you know, the stable coins would be closer to narrow banks.
Yeah, I mean, it's a narrow bank model,
if I could put it that way. So, and there is a big question around deposit insurance and how you could do deposit insurance, or whether you need to do that as well. But in economic terms, a stablecoin backed fully with reserves would be equivalent to a central bank digital currency, and a stablecoin backed with HQ high quality liquid assets and the like would be equivalent to a narrow bank. One isn't perfectly protected in the banking system. One's only protected up to 85,000, if I can put it that way. So, if you like, a central bank digital currency or a stable coin backed with 100% reserves will be a safer asset.
You could change that through regulation of the commercial.
We could. So the point I was making earlier, that we could do all of this, one could attempt to do all of this by regulation. One thing that would disappear, and it's really impossible to prove one way or another how much this matters, is the public would not have access to something from the state which says, I promise to pay the bearer, which I think is what most people, when you ask people what they think about money, the image they have of money is physical cash. That may be to do with the fact it's physical, but it may also be due to the fact that they have a claim on the state. They would not have that if all they saw was the private sector stablecoin issuer. I mean, the question is, does that play a role?
My very last question, I promise it is the last. Yeah. Is there an issue that you're worried about if you get involved in providing this new dimension of the payment system, that you would be undercutting competition from the private sector as a state body? And what aspects of the system might raise that question?
It's interesting. I'll start off because it sort of goes back to the Christopher Waller question, which is what problem are we trying to solve here? Because if I sort of lay out the set of things that get said to us on this, one of the things that gets said to us, and we saw an illustration this last week actually, which I'll come back to, is, and it's often said by some of the banks actually, which is, you should do this because it would actually reduce the cost of the payments infrastructure. And it's a particular point made about the card, the cost of running the cards, or the charges that the card providers levy. And you saw this last week when Amazon said they were not going to take Visa cards in the future. Now, my reaction to that is, I mean, as we know, again, a discussion issue we've discussed in the past is that there is a competition issue in there. I think it's been around for a long time. You can go back a long way in that issue. I think, again, we need to do the work on this. My own view is I think issuing a central bank digital currency is a sledgehammer to crack that one. On the other hand, the nut has refused to be cracked for a long time. I would have to admit that. I think there have been competition and markets authorities looked at this issue quite a few times, and it is one raised by the banks. But I think we'd have to be pretty careful about going there in this way, because it does seem a very big innovation to make, if that was the only issue. I don't think it is the only issue, by the way, but I think this conversation is illustrated, but it's one that gets raised.
I think the competition argument plays both ways. So on the one hand, and this is not, when I said at the beginning I was asked what the bank's priorities were, but if you think about some of the competition issues that are raised by money being issued by, for example, big tech platforms, they're potentially very great, and a number of countries are worried about that. A central bank digital currency that the private sector can use in its kind of innovation, I think addresses that competition aspect. On the other hand, if we introduce, in the same way that cash is in competition with bank accounts, if we introduce a central bank digital currency, then other forms of, people may prefer it to other forms of money. And that will depend on the features we give it, for example, whether it's remunerated or not, which will make it kind of attractive or not. But I think in introducing it, we would have to be alive to competition concerns and to make sure we weren't competing unfairly with the private sector. We'd introduce it as if we did, as a public good, service of general economic interest, I think is the EU phrase for that. But we'd have to be clear that it didn't have competition angles.
You're done, Lord King.
Yes.
Lord Bridges, did you want to come in on
No,
this?
no, please press on.
Yeah. Can I just make one comment? It does strike me that your answer, where you said that you were kind of stuck with CBDC because it, had gained, I was going to say gained currency. But Lord King's point that it's not a currency, I mean, this is actually quite important for people's understanding of it. Certainly when we started this inquiry, I mean, the revelation that we weren't actually talking about a currency but a payment system, certainly for me was fundamental. So by continuing to call it a currency, isn't that going to make it even more difficult to explain to the public and others what we're discussing?
We have tried to call it and talk about digital money, and the discussion document we put out in May was about digital money. And we explain in there what we mean by that is what is called a CBDC. I think most people don't spell it out. It's just become one word, CBDC. But you're right. I think if the proposal is to introduce this, we have to explain. And generally, the phrase that we also use is it's digital cash, which I think captures what it is much better than currency. The only point I make about currency, and this goes back to some of the issues about if the private sector starts to issue its own in a walled garden, in a closed system, then you do have the possibility that it develops into a currency that is denominated in its own currency rather than denominated in sterling. So I think settlement assets denominated in sterling is what I think is a currency. I can put it that way.
Well, I think it's an important point, and I know the Governor can be sensitive about terminology. Okay, Lord Fox.
I think
I hadn't asked for a supplementary, Chair.
Oh, I'm so sorry. Yes, go on. Yeah.
Time ago. Thank you. Thank you very much. I just wanted to explore the potential, or it's a point, Sir John, you made about digital currency, the central bank digital currency, as a potential store of value, and the Governor also said that what increased demand for cash, not
Indeed.
transactions during the COVID. And I wonder whether a demand for custodial a function is a result of an increase in uncertainty. I mean, I think Keynes would have called it a demand for liquidity, an increase in liquidity preference. And is that a possible function of a central bank digital currency to be a store of value? Do you see that as a problem for which this might be a solution?
I don't see that as the primary problem we're trying to address.
Right.
But I think precautionary cash holding, which is what people do when they're worried about the future.
Yeah.
I think there is a point which is if the public doesn't have access to cash or to a state asset, and it's worried about the future, is that an issue? So it plays. It's two-sided. On the one hand, you don't want every time people are worried about a pandemic that the whole system goes into CBDC, which is the run, because that's the safest form of asset. On the other hand, and maybe it's a philosophical question, whether citizens have the right to hold some of their money in the safest form, and whether they feel a need to do that. And such research that we have on why people use cash and want to hold cash is particularly around safety. Now, we're not going to stop issuing cash, so to some extent that's there, but it needs to be usable as well.
Yeah.
And if you like, that's part of the issue. So I think there is a role, it's a personal view, that there is a role in giving the public access to the safest form of money, but on the other hand, it comes with a downside that you don't want the whole system to move to that when people are worried.
You're not aiming to supply the public with a safer form of cash holding. than they have at the moment.
Safer in the sense of...
Safer in the sense that its value will be a store of value, in other words.
No, although, I mean, it touches on a number of the questions we've been asked earlier. It touches on Lord King's question, of course, which is exactly what is the difference when you have 100% deposit protection, which has a sort of backing of the state. But no, I mean, not in the real sense, because as you said, I mean, we have no difficulty with the fact that clearly the public do use banknotes as a store of value. I mean, it's one of the natural conclusions you have to draw from this paradox.
Okay. Lord Fox.
Coming back to cross-border payments, Sir John, you alluded to the need for international agreement. First of all, is there a danger of sort of Betamax VHS type situation where different standards begin to proliferate in different parts of the world? We've seen the G7 policy principles document. Is that sufficient to drive a unified approach? And really, if you could give us a feeling for how you think this process might go.
I don't think that the G7 public policy principles weren't really about the standards.
No,
they're around the kind of broader public policy framework. And different societies will have different frameworks, but the G7 economies kind of share a lot of characteristics, which is why it was worth doing it. I think CBDC, the opportunity one would have if jurisdictions decided to issue CBDC, and no advanced economy has made that decision yet. But the advantage have if they were building CBDC systems is that our other payment systems develop domestically without really much thought to interoperability, to common standards. And given that the majority of central banks are now exploring the CBDC question, there is the opportunity to use common standards, common legal approaches, which would increase the ability for interoperability. So I think of it more as rather than is there a danger. I think there's an opportunity here.
Well, we see it as an opportunity, but how does one harvest that opportunity?
So in the work that I'm leading for the cross-border payments, and on the CPMI committee, which I now chair, there is a so-called stream of work. It's called a building block, but it's a stream of work on interoperability and CBDC. It put out a report in May that looked at different types of interoperability. Interoperability can come in different strengths and flavours, and looked at some of what would be necessary in terms of standards alignment to, if you like, to ease the different models. And that's the beginning of this work. There's more work going on to try and drill down and go further. It is, of course, internationally, you can set out the standards and the ways that one might do this. Individual jurisdictions will need to think about how interoperable, and there are reasons why jurisdictions might not want complete interoperability. If we think about dollarization and capital flight, I mean, jurisdictions might not want to make it completely frictionless to move out of one currency into another currency. So I'm not saying interoperability is at the highest level, is the target of everyone. But if we put in barriers to interoperability, we should do it knowingly for a good policy reason rather than stumble into diverse systems.
And is there a first mover advantage? In other words, does the first G7 CBDC drive the standard?
No, I don't think of it that way. I think the primary purpose of a CBDC, if one is introduced, is to solve to answer a domestic problem, as we've discussed. And it's got to be done if it's done in a way that suits the use case in that particular country. And the characteristics are very different in different countries. So we haven't talked about privacy yet, but societal preferences around privacy are very different even among advanced economies. So it's got to make sense in its own jurisdiction. The question is then, can you have something which makes sense in its own jurisdiction that still doesn't put barriers in the way? But I don't see this as being like Betamax or whatever, that there will be a standard that everybody will adopt.
If you don't mind me saying it, it sounds rather vague in a sense, in that there are discussions going on, but in the end, each country, each bank will make its own decisions. So what are the chances of having that?
I don't think it's vague at all. Sorry.
I apologise.
That we have a mandate on UK financial stability and UK monetary stability.
Yes.
And if we were to introduce a CBDC, it's got to be something that suits that mandate. The features it would have to have, and we discussed the use case and the impact that would have on the banking system, would have to reflect kind of the economic nature of the UK and also societal preferences within the UK. I think, and in a way, it's all central banks have domestic mandates. They don't have a kind of international mandate. The question then is, within those parameters, can we try and ensure that we don't put barriers in to interoperability, which may not be the same as us all using the same standard, but in some cases it may. So if I talk about data standards, we might all want to use international data standards. ISO 2022 is the one currently for payments. We might want to have certain information, and we have the chance to build that in from the outset. But the decision whether to do it or not will not be taken certainly not by my committee in the BIS and not by the United Nations. In the end, these things are taken by domestic central banks, domestic governments and domestic legislatures.
If we could just move on to privacy. Vaikan Shandos.
If I could pick up on privacy, it's hard to open a newspaper if that's not an old-fashioned thing to do without reading about CBDC. And yesterday there was a letter in the FT from Richard Gendall Brown, who's a member of your CBDC Technology Forum, and he wrote, if physical cash declines to irrelevance, should we still have the ability to make payments that are not observable or censorable by the state? And that does come to a key issue in terms of the potential difference between physical cash and digital money, is that particularly if you're outsourcing the customer relations, whether it's KYC, through the platform system, how comparable is it going to be to cash, to physical cash?
I would start by saying that it's not the case today that you can do anything you like with cash and it's outside the law. And it's different if it's electronic because one of the banks has just been fined a lot of money for, in fact, being subject to a criminal prosecution for that. So it's not the case. But of course, the means of, if you like, monitoring and detecting are different. That's true. I think I said earlier. I think if this thing is introduced, it will have to satisfy, obviously, the anti-money laundering laws, terrorist financing laws, all the other financial crime laws. I mean, that's a requirement, and obviously nothing is outside that into the means of payment. The privacy legislation, of course, is in the area of data protection, and particularly around the GDPR regulation, which we've obviously taken on from the European Union regulation, and that will apply too. And the question, as I mentioned earlier, and work is going on this, which the Treasury are leading, is if we think about the sort of the design and features of digital currency, does that body of legislation satisfy the need? That's the question you have to answer. And in doing so, of course, the boundary gets drawn between what has to be known to satisfy the anti-crime requirements and what has to be kept private to satisfy the privacy requirements. And I think all the time, I mean, we have to, as a society, we have to draw that boundary, and it's no different here.
If you're going to try to get as close as possible to physical cash, acknowledging that physical cash is subject to, can you envisage a form of KYC that is different from that would apply to a conventional
bank account? Because if you can't, it seems to me Lord King's argument is, Lord King's point, what's the difference, is even stronger.
Well, again, I would say, I mean, as a matter of principle, the KYC requirement in a physical cash transaction isn't different. The question is, of course, is how it's enforced and how it's done. And of course, it is different because practically, these are very different means of transmission.
So, do you think it is inevitable that if digital money replaces physical money, more or less, not, you've emphasised you'd go on issuing banknotes, but if they fell out of use to all intents and purposes, there is an inevitable reduction in anonymity stroke privacy and strengthening of supervision.
This is, I think, first of all, let me say this is not a question. This is not a question for the Bank of England. I think this is very appropriate a question for government. What I would say, I'll venture to give a view, is that I don't think you can really have one standard of privacy in the broadest sense of the word for one set of transactions and a different set because we call it a currency, or to use a different phrase in Lord King's suggestion. I don't think that's possible. I mean, I think yes. So I think if the thrust of your question is that, I think yes, you would obviously they would come together. Yeah, I have to. I don't really see how you could do it differently.
If I can add to that, so I think there is a political, societal question about the extent of anonymous transactions and bearer instruments. And on the one hand, there's liberty and privacy in that sense. On the other hand, there's a lot of work done on the social damage that cash does in terms of money laundering, tax evasion, and the like. So that's a balance which is difficult for the central bank to set. I mean, it's a balance that, if you like, society's got to set about how much. There's then a practical issue, which is, could we issue central bank digital money in bearer form? Okay, and are we thinking of doing that? And first of all, I think if we were to do that and make it much easier for people I mean, we can't freeze the position and just have as much cash as there is now. So were we to issue central bank digital bearer money and the like, this question about in society how much of that should be available, what's the balance between the social consequence of anonymous money, Ken Rogoff's book on this I think is quite illustrative, and privacy. The second issue is more technological. I think while in principle it would be possible, technologically the risks around digital bearer money, the counterfeiting risk, because its computer code is so replicable, I think at the moment looks very large. And it may be that at some point people come up with the technology that can do it, but if you think about how quickly you could counterfeit in a digital world, my guess is that technologically it's a much more difficult thing to do than some form of account-based, whether it's a custody account or a claim account, some form of account-based digital money. Although there may have to be a bearer-type element to it, because not everybody is online. Some people don't have access to the internet in remote areas or whatever. So there may have to be some way of allowing some offline use. But that's really the technological pros and cons should follow the policy choices. And I think the policy choices, if you like, about how much anonymous money you want to have in society, I think is one, as Andrew says, which is it's something that governments and parliaments will need to debate.
I mean, if I just give you a very real example, over the last 2 years we have seen a very large increase worldwide in cyber attacks in the form of ransom attacks, and it is quite typical for the ransom to be demanded in crypto assets because of their supposed anonymity.
Okay, that's a neat segue into Lord Bridges' question.
Yes. If I may then pick up on the point, Governor, you've just made about security risks, and I note that in the discussion paper you state that CBDCs could make it an attractive target for hackers and fraudsters who wish to steal funds. Given that, could you tell us, maybe, Governor, what design principles you think would be required to ensure a CBD system is secure, and flowing from that, how you see the trade-offs that are going to be required between, for example, customer-friendly nature of the CBDC, security, functionality and vulnerability, so on and so forth. Could you just talk us a little through that?
I mean, I suppose I would start by saying we haven't got to that level of detail in the design, so we're still talking about sort of principles here, if you don't mind me saying so. I think you describe it very well. I mean, they would have to achieve, a very clear balance. They would have to achieve a very high level of security, because John just set out the big risk here, which is that instead of counterfeiting banknotes, we've got criminals who are effectively counterfeiting computer code and creating the currency in that way. And by the way, I mean, you do see some very well, some very well-known examples of very big crimes being committed in some of these in the crypto world, and that's of that sort against each other in the crypto world. I don't think I don't know what John does. I don't have a ready answer to your very good question today, which is how do you combine that very high level of security with the appropriate sort of level of user friendliness. I mean, that's a balance that will have to be struck. And of course, the world is evolving very rapidly in terms of the technological world in that sense at the moment. So, I mean, we very much recognise that should we go ahead down this road, that balance will have to be struck. But I have to tell you, that's a sort of step beyond, I think, where we've got to so far.
Just to put it in the context of where we are in the process, if I can put it that way. The next step is to see if we have a use case. We have something we think that answers the problem, I can put it that way. And then to go out to consultation. That will, I think, have within it some of the trade-offs between security, functionality, ease of use that we have to balance. We'll clearly interrogate what technology can do now, but it's only once a decision has been taken, if one is taken to proceed, we produce a so-called technical blueprint, and we would then engage with the private sector to say, well, okay, here's the blueprint. Now looking at it in detail, can you build it? And it may be at that point we have to make more trade-offs between security, robustness.
And then my next question may also be premature, but when are we going to get an idea of how much all this is going to cost?
I think not until, well, first of all, you want to get to the point where there is a use case and a design. I think saying how much this is going to cost, I think, before that is not going to be very useful. When we bring out the discussion paper, we'll have in it some things about how it needs to be built and the like. But even if there's a decision to proceed, and we then go to a technological blueprint, then there are, until you get to the if you like, the point of introduction, then one can pull back. I think the key thing is that decision to engage the private sector to say, can you build this, is really a watershed in terms of cost and investment. We would need to be pretty sure that we wanted to do this before we then got into sort of detailed design, creation, testing, and the like. So I'd say it's around the discussion paper and the technical blueprint is when you'd have some idea.
Can I just, final question, can I just quickly come back to Viscount Chance's point on privacy? Just to be clear, we heard a digital ID is needed to make a CBDC work effectively. I wasn't entirely clear from what you said, Governor, whether you would agree with that or not. Would we need to have, would George Bridges have to come in and get a separate digital ID, do you think, to make CBDC work, or would the current KYC and, as you said, regulatory supervisory checks make it work effectively?
Well, again, it's a design question. I mean, I think my view today on that would be for you to access your account and your wallet, your holding in the wallet on the platform, you would need a digital ID. And that would obviously, and going back to the conversation we were just having, that would have to have security around it. To what extent that digital ID would be something that would be unique to that platform, or something that was broader in terms of your identity, honestly, I think it's rather like John's point on the iPhone. I mean, the technology will probably move us on very rapidly in a short space of time, so it's a bit of speculation to some degree.
Thank you.
I don't think you'll be surprised. We do want to ask you one final question about inflation and QE, but just before we move on to that, once you've, and this has been a really useful session for which we're very grateful, once you've kind of sorted all these problems and decided that you want to go ahead with this, who would have the final say? Is it the bank or the Treasury or is it Parliament?
Well, I think it would be a decision that we would take in terms of in sense of the assessing the evidence with the Treasury. I think John Glenn was here recently, and I think he said, well...
He didn't answer the question, actually.
Did he not? Okay.
I would have said that.
I didn't answer the question.
Sure you will. Sure you will, Governor.
I mean, I think it would necessarily involve the government. But I mean, because we would be implementing it, it would also necessarily involve us too, by the way, but I think the government has to.
But not necessarily Parliament.
If you don't mind me saying so, I think that really is between you and the government. I don't really feel sort of, that's a Bank of England question. How you... I mean, you can put that question in terms of what legislation might be needed.
Okay. Would you require legislation in order to be able to implement this?
I think our view at the moment on that is that to do it robustly as a payments medium, I think the answer is probably yes.
Right, so it is part.
I think I've had lawyers have said to me, well, you could do it in the following way and it wouldn't require legislation. And I think our thinking at the moment is yes, but I don't think that's sufficiently robust. But to be tested. But I think that's my
much better answer.
Current view of the oh well.
It will touch. So there's an issue about whether we could issue one, but other things such as what privacy applies to it, extensions of existing legislation, definitions that would have to change. My guess is the framework around it is some legislative change, regardless of the sort of authority to issue.
Okay. So if I could just raise I'm sure other colleagues may want to come in, but with inflation rising faster than the bank previously anticipated, is there still a clear rationale for continuing asset purchases until the end of 2021? I mean, the other day, you indicated that the decision not to raise interest rates was a very close call.
Yes.
Which leaves me thinking, well, why then do you think that injecting any more liquidity into the economy is a good thing?
No, I'm happy to answer that question. And a similar question I had at the Treasury Select Committee last week. It was a very close decision. We undertake quantitative easing in fixed amounts and over a defined period of time. That period of time, as you indicated, actually runs out 3 weeks' time. In the language of tapering, which is really more used for central banks like the Federal Reserve that undertake open-ended quantitative easing, but I'll use it for the moment, we are therefore fully tapered in 3 weeks. There's nothing more after that. For me, and I'll speak personally now, the judgment was the following. Was it better to end it at that point with only a relatively small amount still to do, which would have therefore a relatively small effect, but in doing so to go back on the principle that the Bank of England undertakes fixed amounts of QE, the effect of which we think is felt more at the point of announcement rather than during the course of it, which is more the effect, I think, for those who do open-ended QE. Because if we had cancelled the last part, we would effectively be saying, should we do it in the future? And by the way, I'm not signalling that we will, I'm just saying, should we? We would have left people saying, well, of course, actually, when the amount's a fixed amount, it might not be a fixed amount because they've just changed their mind. And my judgment was that for the small amount left, I did not think it was sensible to breach that sort of, in a sense, that policy that we've had and that approach that we've had for the future. And that was what lay behind my decision.
Okay. Lord Bridges?
Just on communications in the round, and in terms of consistency over the last few months, Governor, how do you feel it's played out? Do you feel that you've been consistent in your communications and getting the balance right between avoiding nasty surprises and essentially giving maybe too much forward guidance?
Well, let me put this into a little bit of sort of context. We have had obviously indications that inflation was rising really since sort of late spring. The amount by which it's rising has changed. Now, I was concerned, and we have, made clear in our minutes and in our statements that we would respond to that. My concern over the summer was that, and it's not just true in this country, I mean, it's particularly true in the US as well, that markets were actually, frankly, taking no notice of this. I mean, paradoxically, if anything, market rates were coming off during the summer at a point when, our thinking was going in the other direction. And it was pretty clear that there was some quite big activity in the markets. I think taking the position that the central banks would not react to this increase in inflation. Now, we've obviously had a big debate and continue to have a big debate about to what extent this inflation is transient and to what extent it's got sort of more second-round effects to it. But my concern as we went into the autumn, I made a speech in September which I think sort of put more force behind the concerns. But I was very concerned that, frankly, people thought that central banks, of which we were part of that, were not, I think, to use a phrase I think Chief Economist Hugh Pill used, and I've copied from him, not in the price stability business, but of course that's exactly what we're in the business of. And so, I made some quite clear remarks which said, people need to understand we are in the price stability business now. We have to judge, of course, the causes of the increase in inflation, the likely duration of it, and the risks that flow from that in terms of second-round effects. That's what we do. But it was a very clear message that I gave that anybody who thinks that we're not in the price stability business and that we won't react is wrong. It did not say, because we would never say this, it was a conditional statement. It did not say, and by the way, we're going to raise interest rates at the next meeting, because that obviously is a judgment for the MPC, meeting by meeting. But it was a very clear message. It is consistent with the statement that we put out 3 weeks ago in the November Monetary Policy Report and the accompanying statement, which said, if the economy evolves in line with the MPC's view and in line with the view described in the forecast that we've just published, we believe that we will have to raise rates in the coming months. Now, on the guidance points, we discuss this a lot. I am not a supporter of what I might call some of the harder forms of guidance, the more sort of automatic forms of guidance. I don't think they've had a good history. I think there is a boundary between what I would call guidance and sort of, in a sense, setting out our view of the world, which is frankly, they do at some point merge into one. But I think that I do not, for myself, think that we will be going back to a harder form of guidance, because I think that has all sorts of perils attached to it. And I think we will keep under review what I would call the boundary between giving the sort of signal that we gave 3 weeks ago, which essentially said, here's our view of the world, here's our view of our forecast, this is what we think follows from it, with a very clear message that if the world evolves like this, and it's a forecast conditioned on market rates, then then the bank rate will have to go up. There is, of course, an alternative view, which is we should essentially go meeting by meeting and not give guidance, and that is not off the table by any means. That's a very, very, well-trodden ground for the MPC, and I could imagine us going back to that. We have, been obviously through what I might call tumultuous times in the last 2 years, and I think, the difficulty of trying to give views of what we think could happen in a world of very high uncertainty is very challenging. And using guidance in a world of high uncertainty is very challenging, I have to say. And it's a very fine boundary between saying, let's not do that, let's just not say and wait. And we keep that, all I can say to you, and I hope you realise this, I think it is a sensible thing to do, we keep that under almost constant review. Almost every meeting we discuss that, which I think is the right thing to do.
Lord Livingston.
From my recollection, Governor, when you were here talking about QE and we are reversing, you, I think, indicated that interest rates would have to go up quite significantly before you would start embarking on this. Is that, in retrospect, do you feel that that maybe some aspect of QE, particularly reversal, is a more flexible tool and a more fine tool, and is that still your view that you'd want to see interest rates go up quite significantly?
Well, we've actually announced, of course, our policy, our approach towards towards that question. We announced it in August. Just to put a bit of context on that,
I'm asking, has it changed your approach?
Not since, well, if you don't mind saying so, when I started my term, the MPC had adopted, I think it was 2019, wasn't it, John, actually, a policy which said that the bank rate would have to go up to at least 1.5% before there would be any unwinding. Now, the problem up until now, because it's changing, is that actually bank rate never got up to 1.5% on the forward curve in the markets. And we did have a discussion, which I partly prompted because I was the member of the committee who came on the news saying, well, hang on, don't we need to revisit this? Because I must say I feel very uncomfortable about having a central bank balance sheet which doesn't unwind. I think QE is a counter-cyclical policy, and the logic of a counter-cyclical policy is that to some degree the central bank balance sheet is counter-cyclical. By the way, I would just add, of going back to the previous subject, of course, the degree to which the central bank balance sheet will turn out to be counter-cyclical does partly depend on what we do on central bank digital currency, but let's park that one. Now, we therefore reviewed it. In August, we announced two things. One, that when the bank rate reaches 50 basis points, it's 10 today, we will cease to reinvest. In other words, as the gilts roll off, they won't be renewed. That's a fairly gradual runoff of the QE stock. And I should add that, of course, an interesting question is, what is the sort of the bottom of that in terms of where does the balance sheet get to before you hit the sort of steady state? We don't know the answer to that question. And the reason we don't know the answer to that question is that the stock of reserves we had before the financial crisis was small. Stock of reserves we have today is very large. The answer to what is the equilibrium level of reserves is somewhere between those two numbers, because we require the banking system to, rightly because of the experience of the financial crisis, to hold much larger stocks of reserves for liquidity purposes. But it's clearly lower than it is today. Second thing we announced was that when the bank rate gets to 1%, and the verb was different here, it wasn't automatic, it said we will consider introducing active sales of the gilt portfolio, and that's where we are today.
And you still don't feel that it's a finer tool that you can operate more effectively, so you're sticking with that?
Well, I'm very keen. I mean, the no reinvestment rule really puts it onto what I call fairly much onto autopilot, and then we have a choice then when we get to 1% to be more discretionary. It's very clear to me that we cannot have a balance sheet that remains this big permanently. Yes. But let's put CBDC to one side for a moment. I mean, that's another issue. And particularly if, at any point in the future we need to use the balance sheet again. So it needs to come down. And we need to have policies that bring it down. And the problem with the 1.5% policy, to my mind, was that it didn't do that satisfactorily. So that's where we are today. We have a plan. I think we're probably the only central bank that's announced that, actually.
Thank you.
Lord Fox.
Given the scale of the energy price increase, given the constraints on the supply chain and the tightness in the labour market, what actually can interest rate rise do anyway?
Let me draw sort of distinction between those issues. The energy price rise, of course, is very difficult. I mean, you probably know wholesale gas prices have doubled since the beginning of August. They're 300 or 400% higher than they were pre-COVID. Approximate issue, as far as I can see there, I'm told, is that currently, particularly in Europe, we have very low reserve gas stocks. And that has driven the price up, particularly the most recent price up. There may be longer run issues as well. There's an issue with I think, lack of supply of liquefied natural gas from Asia because of Chinese demand. The thing, and there's a shipping issue. There's an underlying issue that COVID shifted the balance of demand in the economy from services to goods. Because, of course, we couldn't, there are quite a few things in the service sector we couldn't do, go out to eat, go to entertainment, what have you. That is slowly shifting back, but it's quite slow, and this is happening in other countries. That is increasing the pressure on shipping. The reason we've got shipping problems, for instance, is that. Those issues ought to unwind. The labour market, and this is why we've highlighted the labour market, is different. The labour market is very tight. And this is the thing that concerns me most. I mean, and will be I can tell you the focus, I'm sure, of our meeting when we have it in 3 weeks' time. We have a very tight labour market in this country at the moment, as best we can tell. There are a number of reasons for that, one of which is the recovery. We've had an increase in inactivity in the economy, which is people who don't have jobs and aren't searching. We've had, as I think I highlighted in a newspaper this weekend, we've had an increase in public sector employment. We've probably had a decrease in the labour force, in the population, but it's very hard to measure. It's pretty hard to estimate, but we think the population is less than we thought than it would have been in a sort of alternative scenario. All of those things are contributing to tightening the labour market. And I do a lot of visits around the country. I do a lot of virtual visits around the country, and I can tell you, I'm sure you hear it too, businesses, this is the primary thing that businesses talk about, and the problem of hiring at the moment. And that is my biggest concern at the moment, I mean, frankly.
If there are no other questions, can I thank you, Governor?
Very welcome.
And so on, for what has been a really interesting session, and look forward to trying to answer some of the questions in our report, which we've discussed.
Please do.
We've discussed this, including what the point of it of a CDC is. But thank you very much indeed. You've been with us for 2 hours. We really appreciate that. And I'm now going to draw this session to a close. Thank you.
Thank you.
Thank you.
Thank you.